Parker, Gideon, and John talking about the ERCOT reliability, kind of setting the stage of what's happening here in Texas with the massive load growth, whether that's through the oil and gas in the Permian, that's AI data centers coming this way, or it's just natural load growth from people people moving to Texas, business moving to Texas. And so all of these inputs are going to affect ERCOT's real-time energy market. And so we have experts on the panel today to talk about that. Doug from Foundry, Haley from Luxor, and then Kevin from Riot. We'll just start with some quick intros, and then we'll get right into the thick of things. Kevin, you want to start?
Sure. So Kevin Haugen, I've been at Riot for almost 4 years, and I manage our energy strategy and trading.
Haley Thompson. I work at Luxor on the energy desk, and I've got a 10-year background trading power as a speculative trader.
Doug Allen with Foundry. I've been in the Bitcoin space just over 3 years, but most of my career has been in energy management services, working with customers, end users that use a lot of energy, gas, power, to run their business and make stuff. So I look at what are your energy inputs relative to your productivity, profitability, and output.
And Bitcoin mining is unique in the sense that 95% of our costs are just directly energy outputs, right? We are the most rational consumer of electrons on the grid. And to be a consumer of electron on the grid, you're going to be divided in Texas into load zones. So Kevin, you guys represent load zone north and south, right? And then Doug, your facility's out in West Texas. And so how does the location of the load impact your strategy on fixed price PPAs versus spot? And essentially what we're saying here is, are you long power, as in do you think the price is going higher, or are you short power? So Doug, you want to start on load zone West?
Yeah, in West, so we've traditionally just run a real-time strategy and price responded. That works best for the business model there. We have to think of our business in context because we're not just in West Texas. We have load outside of ERCOT and other areas that's really more of a fixed price type or utility. So I'm comfortable having some volatility in load responding because it's just part of my portfolio. But there are other considerations relative to, how would I buy that power out there? How would I hedge that through fixed price or PPA? What sort of basis risk or exposure? And how much premium would I have to pay to do that? And one of the things I always have learned in my career is all options have value, whether it's a stock option or an option you have on an energy futures contract. So you want to monetize that option. And in Bitcoin mining, relative to energy, we have a nearly perfect option in the ability to curtail very, very rapidly and to ramp up relatively rapidly. So we want to get the maximum value out of that option. For our business, our strategy, and our load zone, just that real-time strategy works best for us there. Other businesses are going to have, based on where they are or their strategy, might take a different tact on it.
And piling on there, so we also operate out in West Texas. We affectionately call it the Texas hedge, just riding the real-time index. Did you seek out West Texas for any certain characteristics, or was that just the opportunity presented?
It was the opportunity presented on how we acquired that facility. It was sort of a package deal from facilities across the U.S., and that was one of them.
And then Kevin, you guys started at Rockdale, which is in Load Zone South. Was Corsicana a strategic move into Load Zone North, or was it just the opportunity presented again?
Yeah, so we changed up our strategy between the two sites, and just to give some background on why we changed it. So going back to Pierre's slide, the market, so ERCOT's fundamentally changed over the last 3 years. Pierre had a good slide. I think 30 gigs of Bitcoin load across the whole world. Well, so since 2020, ERCOT's added 40 gigs of solar and battery. So just ERCOT alone has built more solar and battery than the entire globe of Bitcoin mining over Bitcoin's whole lifetime, which is pretty mind-blowing to do that in 4 years. So we thought, there's going to be a lot of negative price hours. There's going to be a lot of low price hours. It's nice mining Bitcoin at negative prices. So we went index power in Corsicana, whereas Rockdale, we've got a really large hedge at about 350 megawatts of hedged power in Rockdale.
And Haley, you wrote a recent article that just came out on fixed versus spot versus a mix. So Riot's doing a mix, Doug is doing spot. Like, how would you, looking at the different load zones in your energy trading background, would you look at each of the zones, their generation mix, and like, what would you personally do maybe in each zone?
I mean, that's a tough question. A lot of how you approach hedging, or how I view you approach hedging, it's not about taking a directional bet. It is more about certainty. So having, if you're deploying a bunch of capital, you kind of want a certainty around there. How I would look at the different zones. I mean, one interesting piece is, we're talking about fixed price, but to your, when you alluded to options there, when you look at this dilemma, should I ride spot or should I get a fixed price? If you go fixed price, like, you have a different relationship with volatility, and so there's volatility baked in. What you referred to as the premium, that's often a volatility premium, and you can get the pure exposure to that by getting an option. But if you're a consumer of power and then you're long a fixed price, you're long volatility. You really benefit from volatility. I mean, the simple way to illustrate that is let's say your break-even cost of power is, for an easy number, $100 a megawatt hour. If you're riding spot and you hit that $100 a megawatt hour and you ramp down, you don't really care if it's 100, 200, 500. It's all the same to you. You're offline. But if you've got a hedge, if you're long power and you ramp down, you're now long power. And so the higher that goes and the more volatile that is, the more money you make. So a lot of this decision, I would look at all those load zones, and I would say, where's the volatility? And it's not, load zone west where you guys are. The volatility looks different, essentially, if the sun is up or not. So on peak, generally, to generalize, when the sun is up, it's not overly volatile in load zone west. Off peak, when all that solar disappears and it has to get backfilled from the grid, things go haywire. So there's it's not even just should you be fixed price or not. You'd look at the off-peak block differently than the on-peak block. I really do think that a mix is a pretty good approach, because I won't say it's the best of both worlds, but it's a bit of both worlds. So you're unlikely to be completely wrong, or you can't be completely wrong if you have a mix. Whereas if you take one bet, one side or the other, you can be very right. I think Riot was very right in summer of 23. But you can be very wrong as well. So that's a mix is my preference.
Yeah, we energized at Cholla in the summer of 23. We turned on at the end of July, and we're operating through August of 2023. And for reference, Pierre had it on his slide, but that red slice there was very scary. Every night when the sun went down, I was like watching my computer, hoping and praying that we were going to be able to turn off, because we didn't have anybody staffed out there. So we were completely reliant on software. Thankfully, Linkcoin Load Now had the guys on deck helping me out, but it was a one-man show, and it stressed me out, because you're riding the risk. We had 2 megawatts energized out there. Prices were going 200, 300, 5,000. And so $5,000 a megawatt hour times 2 megawatts, you could lose $10,000 in a single hour. And Kevin, you were telling me about Riot and their, you guys started really early, right? Like, this is before Foreman existed. This is before Load existed. So how were you guys dealing with the volatility at your site, and how has it changed over time? Have you is that built in house? Has it gone out of house? And how do you view that?
Yeah, the early days, I think 2021, maybe 2022 is when we had software. So before software, it was crazy. I think there's some people in the audience here that were running around flipping breakers. But with our hedge size, every minute was 60 grand of power cost if you don't shut down. So you're calling the electricians on site and they're hauling ass to go flip breakers, and it's 10 minutes, right? So, So you could burn 600,000 while while you're waiting on people to flip breakers. But luckily, software came around and we can shut down now in a minute or two.
Doug, and do you use outside software, or have you guys brought that in-house?
We have our own software that we've developed for the sites that we own, the sites that we operate for other people, and now it's available to the market. And that is an important point. There's price risk, but then there's operational risk, right? And how your miner management software handles that operational risk in terms of responding to price, how quickly it's bringing those machines down. There's a trade-off and discussions that will have to happen with your operations team about, well, how quickly can I bring these on and how quickly do you want them to come back up, right? Because those prices can move. And the operations team, they may want them, I need you to bring it down really slow and leave it down and don't flip it on and off. And you have to be able to quantify, okay, what's the cost of doing that, right? In terms, because there's wear and tear on machines. It's like, when I was a kid and my cousins and I would run around my grandmother's house flipping the light switch on and off, and she'd yell at you, right? So it's the same thing with the operations teams. Like, so you're flipping everything on and off too quickly. So how your miner management software responds to that and gives you flexibility to do that, and not just managing, how it's looking at prices, how price sensitive is it? Are there other things built in there? Like, our system looks at ERCOT overall load and can respond to ERCOT load, right? I can set a level if I want, we're getting too close to a 4CP too quickly, it'll bring it down. So how does your systems work? How does your operations team, and does it work, right? Because our system's really good, but I still get alerts like if something's funky with the network, I'm like, hey, we are going to go down, right? If price does run away, even though it's a nice summer spring day and power price is $20, I'm still concerned. What if something happens? Operationally, does everything still work?
And then speaking of kind of like a Haley for Luxor, I know this isn't exactly like firmware is not your department, but is Luxor working on like an optimization of firmware with energy grids and like kind of flexing the miners up and down based off of the real-time price of power, like to kind of follow and change your break-evens over time? Like, is that something that you're looking into, trying to really squeeze out those efficiencies?
Yeah, so we're working with miner manager software to do this, but we are trying to get a little more dynamic than the existing, kind of set it and forget it set point. I referenced $100 break even or $85 break even, but this can fluctuate on a weekly, daily basis. So we are working for the miner management software. There's lots of great options out there, but to have a more dynamic response, so not just this set price. And then I think what you said, cost of curtailment. I mean, that's also very important. If you're going to lose a penny, maybe you don't the whole facility. Maybe you don't turn offline because there's more going on. There's more costs associated with it. So baking kind of quantifying those, and that'll be different for an S. I think you'd be willing to put an S19 through a little more work than a S21 hydro. So having that dynamic, not just for your site, but even right down to what machine, different costs of curtailment, different decisions being made at the same price.
Yeah, I mean, the industry's definitely maturing. We've gone from flipping breakers to curtailing via APIs, suspending, like Doug said, like there's a cost to turn these off. There's a higher cost of flipping the breaker, power supplies break. It's an expensive repair. You want to keep these things up. Switching gears a little bit, when looking at the addition of kind of variable generation into the ERCOT mix, right? Like we're going through a complete energy transformation. Like Gideon was saying, thermal generation equaled load 100% of the time. It ran, it tuned up, it tuned down. Now, and you could control the generation itself. Bitcoin miners, flexible load. We can turn on and off. We can respond. We can consume those cheap pricing intervals when the solar is producing, when the wind is producing, but then we can turn off when it gets expensive. And so, how are you looking at providing into one? Where do you think power is going in ERCOT? are we going to lower prices more often, but with higher volatility? Or will it kind of normalize with the addition of battery storage and then just like increased generation capacity?
Probably, we were talking about that earlier.
Yeah, I think you've got to know what's going to happen to demand to really answer the question, which we have no idea. We can't figure out how much AI is coming on. I think in the short term, the forward curve's probably a little too high. So after Uri, when we entered into the hedge in Rockdale, prices were sub 3 cents a kilowatt. Now they're 5.5 cents a kilowatt. So prices have doubled. But with all the solar and batteries, real time is kind of dead right now. So for us, I don't know, like that was part of the thesis of being on index. I think prices, until there's load growth, are going to kind of be dead. But people think load growth is coming in the next year or two, so we'll see.
And load growth doesn't happen overnight. Anybody that's here participating in the market in ERCOT realizes that even though we are the best, things are slowing down. You've got interconnection queues out the wazoo from everybody trying to put a gigawatt data center in there. We're one of them. But with this, like solar can be deployed it's like a consumer electronic at this point. Solar is like pretty much doubling year over year. We're hitting records in February. How is that, along with their low price, like the ITCs? Basically, you can bid in solar at $0 and still make money. Like how do you look at that and the generation interconnect queue being a lot of solar? Like how does that affect your strategy? Especially because, Doug, maybe you have that answer, because a lot of it's focusing out in West Texas because that's where the highest solar irradiance is.
Yeah, I don't know that it would change the strategy too much. Again, trying to maximize that optionality. If I had a more of a bias on what forward hash rate was going to sell at, like we were talking earlier, if I could sell my forward hash rate, I'd be much more inclined to lock in power, right? Because I could lock in a margin, right? And as our industry starts to mature and change and develop those tools, we'll have more flexibility on how we want to run that part of the business. Right now, for West Texas, as I tell the team out there, you're going to see curtailment hours where we're price curtailing are going to change. It used to happen now. Now it's when net load is shrinking. There's so much solar on, but also that changes the 4CP strategy, right? Because last year we were seeing 4CP risk, and prices were $20-$30, right? 4CP, we're past the 4CP risk. Now we're into the evening ramp, and it shoots up to $200 a megawatt hour, right?
Do you want to give a quick 4CP primer on explain like I'm 5?
That's a whole different topic.
Okay, but basically, I'll do it as best I can. 4CP is for coincidental peak. It's the peak load of the system in the summer months. So it's a transmission recovery. It's a way to put transmission, all these big power lines going across the state, getting the power where it needs to go, to basically the grid payers and like the right payers commoditize it and pay for it. Haley, for the hash rate forwards, is that something like? Do you have a solution for Doug? Is Luxor building that? And how do you view that market in conjunction with ERCOT?
I think it represents the industry maturing a lot, and it's the commoditization of compute, and I would say that we're not just going to see this in Bitcoin. I'm very proud to be on the derivatives team at Luxor. So I work on the energy desk, but that's kind of under the derivatives team, which I would almost say is the commodities team. So seeing that mature is because all mature industries have this. They have the ability to hedge, to forward sell, They have a forward market, like as you alluded to with power, and so we're getting there with Bitcoin. And I shouldn't say Bitcoin, the SHA 256. Getting it with compute. I think we're going to see some version of this for generalized GPU compute coming along. But it's great to see the industry mature, and then by pairing, we're building an energy desk within the derivatives desk, and then that would allow what we've kind of dubbed internally. This probably won't be the working name, but a hash spark spread. So for any power people, spark spread has been a term in the industry for years. It basically is the difference between the natural gas you buy and what it's worth it for power when you convert it through your gas plant. So the hash spark spread is essentially the same, that you're forward buying your power and you're forward selling your compute. You're locking in a margin, and now your only risk is not price risk; it's operational risk. And that I think that's what miners are operators. Miners stay online. So the operational risk is what they're saying, they want to take on. Taking price risk, I mean, maybe investors want that. I think we all want upside to Bitcoin, but being able to offer a product where it's just the only risk left is operational risk, I mean, it's a great thing to offer, and I think there's appetite for it in the market.
Right, and different players in the industry are going to want to take different risks. Right, if you're a large institutional miner with investors, you may want to try to de-risk your business and focus on that operational efficiency. You're a smaller miner, and you have enough capital, but you want to take more risk because you want to make a lot more money quick. Then you're going to take on different risks. So you're going to manage how you buy power, how you forward sell that hash rate. How do you hold your Bitcoin, or do you convert it to fiat? Those are all parts of this business. So back to our initial question of PPA or real time. We've all chatted a little bit in the answers. Well, it depends on your business, right? It depends on how you want to operate, what your investors want. You probably have investors that are concerned about how green are you, right? Well, okay, if I want more green energy in the mix, maybe then I do a PPA, right, and have some solar offtake and build that in. If I'm not necessarily as concerned about that, maybe I'm not going to do that. Or maybe there's a market. There are developing markets. Some of the large Meta, for example. I've been approached by people representing Meta saying, if you guys turn off at this time and give us, we might be able to monetize the environmental attributes. So all these things are starting to happen in the market. So we're going to have a lot more levers to pull, I think.
And just to add to that, the answer is, to the topic of the panel, it depends, which can be a cop out, but it does. If your core business is Bitcoin mining, if you consume power to turn it into Bitcoin, you do nothing else. I think it's pretty wild that you wouldn't manage the risk of your core business. So you should look to these tools to do so. If your core business is producing oil and you view Bitcoin mining as a way to mitigate flare gas, and you don't really care how much money it makes, well, you might as well just take a flyer on all that upside. Like, what does hedging that really help you if that's not even how you're approaching? It's not your core business. It's on the side. So everybody who approaches these products, approaches this decision, they have to what's your risk appetite? Is it your core business? It's kind of it depends scenario. Analogy would be a financial planner. It's not like you walk into a financial planner's office and they just have a plan, a one size fits all. You're going to sit down and they're going to say, well, what's your goal? What's your scenario? How old are you? You want to send your kids to college? So that's just an analogy, but that's how you should approach hedging. It's not just there's a right thing to do and there's a wrong thing to do. It's what fits your operation, your risk appetite.
I think if you're willing to shut down for 10, at least speaking for ERCOT, if you're willing to shut down 10 or 15% of the year, you're going to be on 85% of the time. You're going to get a really low power cost, probably like $20 to $25 a megawatt. So if you look at the forward curve and you say, hey, I can hedge for $50 a megawatt year round, like that, you're taking on a lot of risk, right? To try to make up for that difference between 25 and 50. So I think it's weird. Like most traditional businesses, a hedge is not speculative. Like you're doing it for the predictability of your cost. But for Bitcoin, like if you hedge at the wrong price, it can be speculative.
And I do think, to your nod of premium, I think a lot of that, so like I agree with you there on your numbers. And so if you're buying the strip for $50 and spot 85% of the time is going to be $25, you're actually not long power. I mean, you are, but in my mind, you've gone long volatility. What you're hoping is that 15% of the hours are just going to be monster prints. And so if they're not, then that hedge is going to hurt. I think we saw people do that in 24, kind of following 23. And I don't even know if all those companies knew that they weren't actually long power; they were long volatility. And that volatility, I was working at a hedge fund on the trade desk. That volatility did not show up, and it was very acute across the industry. So.
Yeah, 2024 was completely benign pricing. Everything was following the summer of 23, very hot. Like we said, August 2023, second highest pricing month of all time in ERCOT, following Winter Storm Uri, when like the price cap was $9,000 and it was 2 weeks of chaos. And so people went in and you have to book it against the market, right? You have to book your PPA against the market. If you bought a PPA for $50 in real time on average at maybe like 95% uptime is settling at 25, like you lost that trade. And like
right, and with a PPA or a hedge, and we've also chatted, what's a pure PPA or what's just a forward fixed price deal with an REP. There's some cost to that also in terms of how you capitalize it, because you have to essentially prepay that. Or if the market moves against your hedge, you could get a margin call, and you have to be prepared for that, right? So, we're getting into areas that a small miner might be like, well, what are you even talking about? You block in power, you could get a call saying, hey, I need another $1 million because your hedge is underwater. You've got to be prepared for that. There's a cost to that as well that you have to net against, against your overall cost of doing. So, the cheapest, easiest way, you've got to prepay a little bit, and there's some tools coming in the market, like with what Sonoda's doing, to lower that credit requirement, even on an index deal, which is helpful. But that may be the lowest cost entry into buying power.
And that's the way that we looked at it with Choya. Like, of course, we have to post some collateral with our REP or retail electric provider, but it's not buying out, a 24/7 for the months of, the whole year. And I guess we've got a couple minutes left on, whether we're going PPAs, whether we're going spot. How would you guys look at the seasonality of the pricing, right? Like we saw from Pierre, he was talking shoulder months, a lot of renewables, not that much load. So generally benign pricing, but then you have summer. ERCOT was traditionally a summer peaking system. Maybe it's transitioning towards the winter time. But like, how would you look at summer months versus winter months and a different strategy there?
Yeah, so for us being in ERCOT, and we're in a unique position where we've got this long-term hedge till 2030 at a really cheap price. And so I think we're like at the end of Q1, we were like $300 million in the green on it. And so we try to figure out ways to monetize it throughout the year. So we're selective in which months. Some months we might ride it to real time. Some months we might forward sell it. But trying to pick those months. And I think with solar, with the amount of solar and battery that's come on the grid, those shoulder months when all the nat gas generation goes out for outage, they're starting to get a little scary. And I think you're going to see a shoulder season blow up. So it hasn't happened yet, but I think it's coming in the next year or two. So we try to hold on to shoulder months. We sell some of summer, but it just depends on kind of what the market does throughout the year.
One dynamic, I mean, we didn't touch on it much, and it is a whole different topic, but it does feed into the PPA versus spot, where if you want to participate in the ancillary service market, so you want to, there's been discussions today about providing reliability. So the way miners do that is demand response, ancillary service markets. If you want to participate in those markets, there is an absolutely massive risk to being on spot. Because what you essentially do is you say, okay, I'll ramp down if you tap on my shoulder, which means you have to be online so that if they tap on your shoulder, you can go down. And that means if prices go to $5,000 a megawatt hour, and you're losing $10,000 an hour, you have to be online because you've committed to that. So that's another. I mean, so I think you probably guys also pick your hours, maybe even pick your months that you might participate in those programs. If you're on a PPA, you want to be in those programs on hours that aren't going to blow up, and then the hours that might blow up, you don't want to be on these programs. You want to be able to resell that power. So it fits into seasonality too, but maybe if you really wanted to get into these programs, then you would get a fixed price hedge for a season, for maybe just on peak, because you don't want to be exposed to that risk.
Yeah, and especially because in the ancillary market, we're seeing battery storage bid that price down and down and down. So we were talking about this earlier. It's like picking up pennies in front of a freight train. Like you could get crushed.